By the end of this video, you'll know almost every trading term that scares beginners away. Each one explained clearly. Each one turned into a story. Let's start with the most basic question of all. What's trading? Imagine you found a rare comic book in your attic. Your friend offers $50 for it, but you know a collector nearby who'd pay $80. So you sell it to your friend for $60 instead. He's thrilled. You made $10 just by knowing the price difference. That's trading. Buying something at one price, selling it at another, hoping the gap favors you. Markets run on this idea, just faster, bigger, and far more addictive. But trading isn't just one activity. There are different styles built around one thing: time, how long you hold before you sell. There's intraday trading, swing trading, and long-term investing. 3 speeds. 3 mindsets. Let's meet someone from each. First, intraday trading, also called day trading. Meet Emma. She wakes at 8, coffee in hand, 5 screens glowing. She buys a stock at 9.16. By 9:40, it's up 2%. She sells. No positions left by lunch. Intraday trading means opening and closing every trade within the same day. Speed is her weapon. Sleep is her enemy. Next, swing trading. Meet Jake. He doesn't watch 5 screens. He checks one chart once a day. He buys a stock Monday because he spots a pattern he recognizes. He holds it through the week and sells Friday when the pattern completes. Swing trading means riding a single price swing that lasts days, sometimes weeks. Not as fast as Emma. Not as slow as someone who buys and forgets. Finally, long-term investing. Meet Elena. She bought shares in a coffee company 9 years ago and hasn't touched them since. No daily charts, no panic during dips. She believes in the company, not the chart. Investing means holding an asset for years, even decades, betting on the future instead of tomorrow morning. Now that you know the 3 styles, let's cover the words traders use constantly, starting with market mood. Picture 2 animals. A bull attacks by thrusting its horns upward. A bear attacks by swiping its paw downward. Traders borrowed these images centuries ago. Prices climbing, confidence high. That's a bull market. Prices falling, fear spreading. That's a bear market. Same stocks, completely different mood. Next, protecting yourself from disaster, a stop loss. Picture Tom driving downhill with no brakes. Terrifying, right? A stop loss is the brake pedal for a trade. Tom buys a stock at $100 and sets a stop loss at $90. If the price crashes, his position sells automatically at $90, capping the damage. No panic. Just a rule set in advance, protecting him from himself. Now, one of the riskiest tools in trading. Leverage. Sarah has $100, but her broker lends her $900 more. Suddenly, she's trading with $1,000. That's leverage. Borrowed money that multiplies both profit and loss. Win, and she wins big. Lose, and she can lose everything, sometimes owing more than she started with. Leverage doesn't create profit. It just makes whatever happens bigger. Next, a word you'll hear every day: volatility. Picture a lake on a still morning, glassy and calm. Now picture that same lake mid-storm, waves crashing every few seconds. Prices behave the same way. Volatility measures how wild those waves get. Calm markets barely move. Volatile ones swing hard and fast. More risk, but also more reward for anyone who can stomach the waves. Now, protecting your money long-term, diversification. Picture a farmer who only grows wheat. One bad season, one disease, and his entire harvest is gone. Now, picture a farmer growing wheat, corn, and vegetables too. If the wheat fails, the others survive. Diversification works the same way, spreading investments across different assets so one disaster doesn't wipe out everything. Here's a strange one, betting on a price falling instead of rising. Short selling. Picture Ben, who borrows his neighbor's bicycle, sells it for $100, waits for bike prices to drop, buys the same bike back for $70, and returns it. He keeps the $30 difference. That's short selling, borrowing a stock, selling it, then buying it back cheaper, profiting from the fall instead of the climb. Finally, a word that decides how fast you can get your money: liquidity. Picture two markets. In the first, you list your car and a buyer shows up in minutes. In the second, you list it and wait months, dropping the price again and again to find a buyer. The first market has liquidity. The second doesn't. Liquidity measures how quickly you can buy or sell something without moving its price. That's the language of trading. Stripped of jargon. One story at a time. Every trader you've seen quoted in the news started right where you are now, confused by the words until the words became stories. Which term's next? Drop it below.